And the anecdote I'll share is that when Dropbox was making the transition from not really knowing what our business model was going to be to actually understanding that we were actually a SaaS product and company, that we actually spent a ton of time reading through a lot of material that you had published, and then going and kind of fit it backwards into a model until it made sense to us. So you kind of became pretty famous within the Dropbox BizOps team as well as the product teams. So thank you for that. So with that, we'll get started. So the format today is going to be that Tomasz is going to give a little bit of background about himself. I have a bunch of spicy questions prepared myself, and I'm happy to go through a bunch of them. But I think the point of having these Q&As is that it's a small, intimate crowd. So feel free to jump in if you have questions. Feel free to kind of ask follow-on questions and so on. And yeah, we'll take it from there.
Awesome. Yeah. Thank you so much for having me, everyone. My name is Tomasz Tunguz. I am 36 years old. I was born in New York, and I have a twin sister and 3 other siblings. We moved about 14 times before I was 15. I spent the first 10 years of my life in Europe, in Belgium, Switzerland, and the UK. I learned English when I was about 7 years old in London. And then we moved to the US when I was 7. When I was 17, my dad sent me to South America, and I ended up starting a company there building software for law firms. And I did enterprise sales, kind of 50K. And it was a great, wild adventure for me. And then I went to Dartmouth College, and I graduated with 3 degrees in 4 years. I studied mechanical engineering and computer science. And my senior thesis was building...
What are the third?
3 degrees. Okay. Yeah, 3 degrees, yeah. And my senior thesis was building the rear suspension of a racing car. My grandfather was in the automobile business, and so I really loved cars. And after that, I went to work for a startup founded by 3 Dartmouth grads called Appian. I was a Java engineer. We were building systems for the BPM company. I was given secret clearance. We built systems for the U.S. Army, Navy, and Homeland Security. I worked there for about a year. And that company ultimately ended up going public. Then I went to join Google, and I started as a customer support rep. And because I was the most junior support rep, I was given the worst customers, which were social networks. And, to kind of give you a sense, this is an AdSense product. Social networks represented 40% of ad impressions on the AdSense network, but less than 2% of revenue. So they were really difficult customers. And so I was Facebook's initial account manager in MySpace and a whole bunch of others.
I did not know that.
Yeah. And then I became a product manager, ran a $300 million a year business unit in social media monetization for about 2 years there. And then I joined Redpoint about 10 years ago. Redpoint's a venture firm that's been around for about 20 years. We manage about $4.5 billion in capital. We have an early stage and late stage fund. We're about 2/3 enterprise, 1/3 consumer, mostly Series A, B, C. And it's been a lot of fun. And yeah, I wrote a book and I read a blog. And I have 3 children, and we're expecting twins in October. So I read an article recently that the U.S. population is not producing enough babies to sustain its population. So I'm trying to do my part.
Amazing. Cool. Should we jump in then?
Let's do it.
All right. So first question, I think it feels as though that even within SaaS, there's been multiple generations of the kinds of companies that we have seen, right? But the first generation was really just taking on-prem software and literally running it on a server.
Yeah.
And I kind of put Salesforce into that category. And not really changing much about the user experience, the design, even the way it was sold. It was just literally you don't have to, there's no more CDs, there's just servers.
Yeah.
I'd say the second generation started to focus a lot more on design, usability, and so on, in addition to kind of being the fact that there's no more on-prem software. And I think the third generation is, for me, the most interesting because you're starting to see hybrid of a lot of the things that we've learned from consumer software around heavy focus on virality, heavy focus on essentially conversion rates on essentially teams, right? And also, most importantly, this whole thing of try to almost have a zero sales team.
Yeah.
So I guess the question here is that, does that resonate with you? Kind of these different generations. Would you kind of characterize them differently? And if anything, what do you think the next generation might be?
Yeah, I think it's right. I mean, I think there's lots to unpack there. The couple of trends in SaaS that I see are, well, let's take that last one for example. There's been a real movement to founders not wanting to build sales teams. And the canonical example of a company that did that is Atlassian. And my argument or my contention is a company like Atlassian will never be built again targeting engineers.
That's wow. Okay.
Yeah.
Can you elaborate on that?
Yeah.
But is everyone familiar with Atlassian here? It's insane. Like 0 salespeople. What is the market cap? 15 billion.
Yeah, it's enormous.
And
15 years to IPO. Never raised a venture dollar. Started in
zero
Australia
venture. Yeah.
around 2002. Growing like crazy. So I think businesses like Atlassian, I put in vision into this category.
Mm-hmm.
And just there are a handful of others, like maybe Asana is in this category, Smartsheet that just went public is kind of in this category. So bottoms up businesses like that can really only exist when the cost of customer acquisition of the end user is incredibly high and classic sales methodologies won't work. Okay, so what do I mean by that? When Atlassian started, engineers had no budget. If you tried to sell to an engineer, they didn't have authority to buy. They were really expensive to acquire. They wanted to test out their tools. An inside sales model wouldn't work, right? So anybody trying to sell to an engineer broke their pick. Like you just couldn't build a business doing that. And so in order to win over that audience, what you did is you tried a completely different strategy. You built a product-first company that had no salespeople, that sold directly, sold through community, and went bottoms up and took its time. And that's the reason why it's not necessarily a great fit for a venture business, because it's 14 or 16 or 18 years to an IPO. After they got to a particular scale, they were able to build a whole bunch of other products to sell through that existing channel. And as that industry and that role matured, infrastructure as a service vendors started to come in, and you had engineers finally starting to have meaningful purchasing authority. Okay? Once you have engineers having meaningful purchasing authority and budgets, the classic sales model starts to work. And so if you were going to start Atlassian today, let's imagine you have Atlassian that's doing kind of the bottoms-up model, Atlassian V2, I don't know, call it whatever, Nuco, and they're competing with somebody who's doing the classic sales model. These guys are going to win because the channel exists. What they're going to do is build an inside sales team, target that budget, shift that budget, grow faster, build a brand, raise venture capital, grow faster, build more of a brand, and keep going. Meanwhile, this company will kind of be too slow and lose the market opportunity. So in each category, like Envision is doing the same thing in design. Designers haven't historically had a budget. All of a sudden, the tooling really starts to matter. They're starting to get more and more of a budget. Envision was the one who kind of built a community around these designers. They're starting to build that channel. And so the same thing will happen. That part of the company will mature. They'll get a budget. The inside sales model will work. Envision will start moving from selling to the individual designer to selling to the manager, to selling to the VP, higher and higher ACVs as they go in order to sustain that growth. And then all of a sudden there's an existing channel. And so basically what ends up happening is who's a sailor? Is anyone a sailor? So if you're ahead in a sailing race, what's your strategy?
Oh, I'm not that good.
Oh, okay.
So you're not really
Catch the wind.
So if you're ahead, obviously. If you're ahead in a sailing race, what do? You copy exactly the move of the boat behind you. Because if you do that, you will always be ahead.
because you both have the same conditions.
And you have exactly the same strategy, right? So once you become the incumbent in one of these categories, what you end up doing is you either buy the smaller guys or you copy exactly their strategy. And so this is why startups need to find a completely different go-to-market strategy to disrupt an incumbent, right? It's the same idea. And so that's why I don't think an Atlassian will ever be built again in engineering.
Did you have a question, Fred?
I want to know what the first product is that Atlassian entered the market with. Just not that familiar.
It's called Jira.
Oh, thank you.
Yeah, no one knows the company, everybody knows the product. Yeah.
But there's not only 2 boats in the race though, right? There's an infinite amount of boats in the race, so you can't copy all of them.
No, but you copy the closest ones. You copy the biggest ones.
I mean, that's a pretty fascinating articulation, which is basically saying that once a particular I think it's fair to say that every function in a company in the future will have budget.
Agreed.
It is ridiculous that in the past, only 1 or 2 functions. When I say function, I mean legal, HR, finance, engineering, product design, and sales, user operations. Yeah. Basically, historically, none of these have had budget to actually spend on software. So you're saying that you can have first mover advantage in each of those, where you can do the bottoms up strategy.
Yeah.
But once you have identified that there is a market, then basically somebody with an inside sales strategy will probably come up as a
Yeah. The only caveat to that is if you're focusing on the SMB, bottoms up will always work.
Sure. Because they don't have the sales.
Yeah, and the cost of customer acquisition is really high. Zendesk, right? Customer support software existed for a really long time. Zendesk went bottoms up, community based. They did a really interesting thing where they found the most vocal of their customers, and the customer support team actually tasked them, saying, Dimitri, this month I want you to introduce 5 of your friends. And they actually put them on quotas. It actually drove a meaningful amount of their business in the early days, all through community.
So I'm going to switch. There's an obvious question on my list, but I'm going to switch to a controversial question and come back to the obvious question.
Okay.
So what's the most overvalued and undervalued public SaaS company right now?
Okay, Domo is the most overvalued company.
But I'm not actually familiar with them.
Domo is a business intelligence company started by Josh James. Josh James sold Omniture for $1.3 billion in 1999.
This is a Utah company, right?
This is a Utah company.
And they're not public, right?
Well,
They
got an S1.
But they filed an S1.
They filed an S1. Oh yeah, asterisk. Okay.
Yeah. So wait, why do you say they're overvalued?
So they've raised. So one really good metric of SaaS efficiency is ARR divided by dollars raised. Okay.
Fair.
So how many venture dollars have you spent in order to acquire $1 of revenue? Okay. They've raised $750 million, and they're generating $100 million in ARR. It's by far the worst ratio. Box is at 1 to 3, so they're 2x worse, and everybody else is basically 1 to 1.5 of that.
Okay. Dropbox never raised more than 450, I think. 450, 500. So
You guys are generating a huge amount.
Yeah.
So the payback period for a customer to Domo is 10 years. The publicly traded median is 18 months.
Okay.
I could go on. What else can I say?
Honestly, though, most BI companies are super overvalued.
You think so?
I think so. I mean, I feel as though that the problem is that they kind of keep on promising a ton of essentially ROI.
Yeah.
But they don't actually end up satisfying their promise. How much did HP buy that British company for?
Autonomy?
Yeah.
Yeah, but that was a search company. And they were totally fraudulent.
They were fraudulent. It was like $8 million. It was fraudulent.
Yeah.
That's true. Okay, what is the most undervalued public SaaS company?
Undervalued public SaaS company? Until a week ago.
And you don't need to say Dropbox.
I was going to say it's Dropbox, actually. Yeah. I think people don't understand the bottoms-up model at all.
Yeah.
I think people just don't understand the power and the capital efficiency of it. And
if you can put it off at scale. Yeah. So, but for context, the reason why I said last week is because Dropbox has a crazy surge over the last week where we surged by 35-ish percent to 40%.
Yeah.
Okay, we'll come back to slightly less controversial questions. You mentioned this a little briefly earlier, but I think the other thing about having so many venture dollars in the market, and having just more and more good engineers, PMs, and designers is that you're getting a lot of small teams working on incredible tools, but that are increasingly more and more niche.
Great.
And a lot of these companies can end up, if you zoom all the way out, be really incredible businesses, $30, $40, $50 million ARR, but have tapped out the market.
Yeah.
These are not ventures class businesses.
Right.
This is not to say these are bad businesses, but in venture you have to keep on running the treadmill and keep on increasing. So how does this play out?
Yeah.
So if you're an entrepreneur building one of those businesses, how should you think about whether it's taking funding, and should you how would you think about that?
Yeah, I think so. I think the first thing you need to do is figure out what your goals are as a founder. And if your goal is to build a business where you own 50% and you sell it for $25 to $50 million and you make a fortune for yourself, then venture capital is not for you because your ambitions and goals are not going to be in alignment with the venture capitalist, right? On a board, we are always going to push a company to grow bigger and bigger and bigger and bigger. And so if at some point you have a number that is not $400 million or more, then, it's not a good fit for venture capital. There's, as software has become more prevalent in all these different functions, you've got lots of different categories where the market size is 50 million or 100 million. And the great part about SaaS businesses is basically a bundle of annuities, right? And these annuities are super predictable. They're really attractive. They can generate meaningful cash flow. And at the same time, and so consequently, they make really attractive private equity acquisition targets. Okay? And private equity, like venture capital, is a huge amount of capital coming into it. And what you've seen is that private equity investors are now paying similar multiples for SaaS companies as public acquirers are.
I did not know that.
Yeah. So if you look at Marketo, Cvent, and a handful of others, they're all paying like 7 to 8 times forward revenues, which is basically where a year ago everybody was. And if you look at 2 years ago, venture-backed SaaS companies, of the share of exits that year, fewer than 10% were bought by private equity. Last year was 50%.
50?
Half. And they're looking at these companies and they're saying, we can put them together, we can reduce the cost. In fact, there are 3 or 4 different private equity firms that are trying to create the Berkshire Hathaway of software. One's called Terra Holdings, based in New York. And they want to hold these businesses for forever.
There's a Canadian one also.
There's a Canadian one called Constellation. It's publicly traded with about $5 million. And so I think basically what ends up happening is you're going to see a lot more roll-ups, you're going to see a lot more private equity, and a meaningful amount of consolidation is actually going to happen through PE.
So for these for the roll-ups that are already happening, what is the operating model that they're following? Are they letting essentially the team and the founders run the company?
Yeah.
Like for instance, the reason I'm asking is, let's assume you're a founder at Subperforms and you're working one of these.
Yeah.
And you decide to take this particular model.
Yeah.
It sounds like what you're really saying is that you have one of 2 options. You either operate a cash flow business, and still great. If you can actually have like a smallish team where you own 100%, 50, 60%, and you have like 15 million in ARR. That's a great, like you're making a lot of money for yourself.
Set, yeah.
You're set. Or you end up getting rolled up.
Yeah.
But you're never going to actually have an IPO.
No.
You're never actually going to have like a major acquisition. Unlikely, right?
Yeah.
But do you think that from are these, I guess...
They have different models. So the way that PE
yeah.
creates value, if you look at all PE funds ever, there's a great podcast on this. It's called Invest Like the Best, and I can send you that podcast. But
Invest Like the Best?
Yeah, it's really, really great. And so there's a guy who analyzes PE businesses. The way that PE generally makes money is just by reducing costs, right? Very few companies taken over by PE actually increase their growth rate. And so what they do is they take a whole bunch of businesses and they consolidate the back end, like the financials, the marketing, all that kind of stuff, and put it in one place, and they grow through economies of scale. There's one company called Terra Holdings. He might be an interesting, Seth Negan, the founder, might be an interesting person for you guys to talk to. His approach is they come in, they buy the business, they want you to operate the business in perpetuity for as long as you want to operate it, and they come in and they really focus on sales and marketing efficiency. And they have a playbook. Most of these PE firms have a playbook where they force you to migrate to Salesforce, they work at the same data model, they aggregate the results up, and they kind of compare you to other people.
That's clever, because it's unlikely that any of these smaller startups are particularly sophisticated about that part of the world.
I agree.
Maybe with that in mind, so give us a couple of, what are 1 or 2 things that most smaller SaaS startups miss in terms of sales and marketing?
Pricing. Pricing.
What do you think? Is it because there isn't generally accepted pricing models, or because people just don't know how to think? I'm curious.
I think people don't know how to think about pricing. I think there are 4 dimensions. This is the present. There are 4 dimensions about pricing.
This is a presentation you're going to
so I prepared a presentation about pricing.
Would you mind sending the deck for that up?
I'd be delighted.
Okay, I would love to share that.
There are basically 4 dimensions on pricing. The first is a pricing philosophy. The second is a pricing structure. The third is a pricing rubric, and the third is a pricing framing. And so I think the problem with pricing is no one has, I took business school courses. I'm sure a bunch of you guys took business school courses. You never took a business school course on pricing. No one ever talked to you about the structure of value-based pricing versus cost-based pricing. No one ever talked to you about, there are only 3 main pricing strategies in the world. There's 3.
Please share.
Okay. The first is skimming. Apple does skimming. So when you buy iPhone X, it comes out at $800. You buy the previous generation, it's $600. You buy the previous generation, it's $400. They're releasing products at very high price points. 1, to reinforce their positioning as a luxury brand, but second is to maximize the profits at every single step. That's called skimming. Right? The second strategy is called penetration.
Can I ask a question about skimming?
Please. What
is an example of skimming for software?
It doesn't exist. because there's no scarcity in software.
Yeah, it's zero production cost. Yeah, exactly.
So it really exists in consumer products. There's a notion of like Giffen goods, the goods that demand increases as the price goes up.
Sure.
So if you think about like art or really expensive cars, like if you're into cars like I am, like a Ferrari 250 GTO just sold for $63 million. And the attractiveness of that car will only increase as the price goes up, right? The second strategy is penetration. Slack is a really great example of this. Give it away for free until you get broad distribution, and then force a conversion to paid, and then move up.
Yeah.
And the third is maximization. So most mid-market SaaS business do this, which is try to extract the maximum customer value per transaction.
Explain that.
So I'm selling, my first initial customer is buying my product, I'm going to charge $5K. Then my next customer will charge $10K. Then I'm going to charge $20K, then a year later $50K, then a year later $150K, then a year later $500,000.
Wait, who does this? What's an example?
Every SaaS company does this. Looker does this, Marketo did this, Gainsight
and the rationale is because our service just became more valuable.
Yeah, the salespeople have way more confidence. I'll give you an example. So what is the biggest contract you think's ever been sold over the phone? You want to wager a guess?
In SaaS.
In SaaS. At least in my experience. Just a rough order of magnitude.
2 million?
What's that?
Billions.
Do you think it's a $10 million deal?
Yeah.
Okay, so the biggest deal I know of is a $2 million deal.
That's it.
And the story, so I met the guy who sold it over the phone, and he was an account executive. He joined this company in France, and he walked in, and the average deal sizes were 15K. Okay, and so everybody's closing 15K deal, and then one guy asked for a 25K deal, and then a week later somebody asked for a 75K deal, and then 2 weeks later somebody asked for a 150K deal, and then a week later he sold a $2 million deal over the phone. What was the difference? Confidence, right? Literally, that's what it is. It's having the brand going in and asking for it, and making sure that the customer's value is there. And I'll give you another example. We were investors in Expensify. So Expensify is bottoms-up expense management. The initial distribution strategy was to give the product away for free. And our investment thesis was that the iTunes store had just opened. SMBs look a lot like consumers. You could build next generation Concur, which is the leading expense management software, going to SMBs by giving the software away for free, using consumer customer acquisition mechanisms, and then converting them to paid after a particular size. At the beginning, we were giving it away for free. It didn't work. It didn't work because people believed that we were doing shady stuff with the data. And they didn't believe that an enterprise expense management software could be given away for free, even though we could make money somewhere else. And so once we started charging more, we started growing much faster.
It's funny, like,
Isn't that funny? Yeah. Completely counterintuitive.
At SPC, Ruchi, Mitra, and I, we're not experts in pricing by any means. But generally, when somebody asks us, like, hey, how should I price myself? So we realize we don't really know, but whatever your gut says, start at 5x.
Yeah.
Because it's really hard to go up later, in our opinion.
Yeah.
But it's like, if you just, and also because people don't understand the value of the software. Like, look at Dropbox. We're like stuck at $10 a user a month, and it's just going to be really, we raised the price to $12.50 a month, and then, that's kind of a big deal, right?
Yeah.
But it's just like really hard to ever go up.
Yeah.
And there's also competitive pressure, but, and I think it's because you're right, like everybody tends to undervalue software for some reason.
Yeah.
They're like, oh, this stuff is easy, anybody can do it. I can, totally get, somebody will totally come and eat my lunch in terms of competition, but that's just because you don't have the confidence in terms of how to price your software.
Yeah. I think the other reason to charge more initially is to validate that you have product market fit.
That there's somebody out there who's paying this.
Because like everybody will pay $10 a seat for a piece of software. Will somebody pay $50 for it? Will they pay $150 for it a month? And so like what you want to avoid in the early stages of a company is getting a false signal of product market fit. And if you don't charge enough for it, then people can be your friends or whoever is going to say, yeah, I'll give this a flyer. But what you really want is people to put their skin in the game. Like the question, there are two discovery questions I found that are really helpful. The first is,
what do you mean by discovery?
Like pricing discovery questions or product market fit discovery questions. The first is, would you pay more so you're given a product, would you pay more or less for this compared to another product? So people have a really hard time answering. Like if I ask you, how much would you pay for this piece of software that I just made? It's a really difficult question to answer.
I don't know how much it was.
Right?
Yeah.
But if I ask you, hey, how much are you willing to spend for this relative to Dropbox?
That'd be easier.
That's a much easier anchoring question, right? And the answer is more or less, and so you can get a sense of priority. The other thing that's really important, particularly in the mid-market, that the founders often make a mistake is if you're going to do a proof of concept, charge for it every time, because what you really want is you're testing the commitment to the product of the buyer.
Even if it's cheap, but it has to be non-zero.
It has to be like 10K or 25K.
Just like make them commit. That's a really good piece of advice.
Because otherwise, they're not going to engage.
Yeah.
Yeah.
And also, yeah.
So one of the questions we ask in diligence when we talk to potential buyers of software is this software, if you bought this software, will you get promoted?
Yeah.
Because
will you be the hero? Yeah.
Yeah, that's what matters. Like the reason I'm going to go out on a limb and buy a $200,000 piece of software, $150,000 piece of software, is because that's going to get me a promotion.
Like everybody's going to be like, you save, you basically save the company so much, or you create so much productivity. Yeah.
And that's a decision that somebody, like if I'm going to go out and ask my manager for a $200,000 investment, like I'm either going to look really good and smart and get the promotion, I'm going to fall on my face and it's going to cost me 2 years of my promotion, right?
The Mark Benioff is a master at pricing. The fact that he gets away, like Salesforce is still 900. What is the price point?
$150 to $175 a seat.
Per month, right?
Yeah.
Yeah, it's crazy.
Yeah.
Charge annually too.
Charge annually up front.
Questions? I'm gonna.
So what do you think about Stripe's pricing model?
Stripe? Yeah, completely different pricing model. It's a transactional pricing model. So they're basically, we talked about the 3 different pricing strategies. There are 3 different pricing models. There's linear pricing, which is Stripe's model. Twilio has the same model. There's 2-part tariff, which is a platform fee plus a per user fee. And then there's 3-part tariff, which is platform fee plus a usage fee plus an overage fee. Think about a cell phone. Right? In the infrastructure space, you see a lot of utility-based pricing. There are a lot of advantages to it. Developers really like it. It's really easy to onboard. Very predictable pricing model, and typically, it's a cost-based pricing. You basically take the costs that you have to bear that service, and you add some kind of a margin, right? So Twilio basically doubles the price to get the 50% margin, and that makes a lot of sense. The 2-part tariff is really common in mid-market SaaS companies. The best pricing strategy in almost all cases, at least in game theory, is 3-part tariff outside of the developer world. So if you're selling to a business user, you should really be using a 3-part tariff. At least theoretically, it's actually proven to maximize value for the business and for the buyer. I can send you the paper.
And the platform part of it is simply like a fixed fee just to be get any access to the service.
Yeah, and the idea behind the platform fee, 1 is to show commitment from the buyer, but 2 is to use it to offset the cost of customer acquisition.
Sure.
So your payback period is much shorter, and the business is far more capital.
And you're using that to basically do it. That makes sense.
Did I answer your question? Or is there a double click you want to do on Stripe's pricing model?
I have 2 questions for you.
Yeah.
One is, you talked about your different approaches to pricing. Have you ever heard of this firm called Simon Kucher?
Yeah.
Okay, so a lot of pricing firms use things like conjoint analysis and whatnot for pricing.
Yeah.
Do you think that that's like a legitimate way to think about pricing? And then second is, I know you said that for SaaS businesses, it's really important to charge upfront for not only like pilots, but also like, charge, the more you can charge, the better in many different ways. If you think about like some businesses where you actually get value from creating like a network effect of some intrinsic property like data, do you think that there's a case to be made for, I don't know, like an Equifax type business where you charge very little or you charge nothing to build up full data and monetize that instead?
Okay, so I'll take the second one first because it's more recent in my memory. I think there are certain businesses that are network effect driven that you can kind of depress pricing initially in order to build that network effect. So like a data.com would be an example, right, which is what Salesforce bought as like a lead sharing thing. But I still think it's important to charge just because it's going to depend on the model. I think the more you get to the SMB, the more likely it is that a freemium model is going to work, right? But the more you move into the mid-market where you want ACVs kind of 50K and above, the more important it is to charge. So it's a hard question to answer in generics, but I think that's a good framework to frame it. Conjoint analysis can be really powerful. Simon Kucher, there's a great book called Monetizing Innovation, where a lot of this concept, it sounds like you read it.
Monetizing
Innovation. It's a really great book. It's actually, I think, the single best book to talk about how to structure pricing I've read. And conjoint analysis works when you've got an established category with established products and people can make trade-offs and the buyer is educated. And for a lot of startups, it doesn't really exist. right? Like you're creating a new category, you're trying to shift, and you're advocating a different value proposition. And so I think iteration works better than conjoint analysis, but at a bigger scale for sure. Yes, sorry.
Do you think that maximization is a long-term strategy, or is it more of a short-term strategy? You can argue that a lot of tech-centric entrepreneurs just aren't super focused on being very solutions-oriented and figuring out how much their customers are really willing to pay. And so is that like a short-term effect, or do you think it can really sustain?
No, I think Salesforce is continuing to do maximization. Like they're just trying to increase deal sizes. That's why they buy companies like MuleSoft. That's why all these different clouds. But once you start selling to like the Fortune 500 or the Fortune 2000, the universe of potential customers is limited to whatever 500 or 2,000, and your goal is really to increase pricing per year. So like SAP has a 5 or 10% increase in price per year, just kind of standard. And the second is to sell as many different products through the channel as possible while increasing the price.
You sell more products and then demonstrate value.
And just increase the price consistently. Yeah. So I think most mid-market SaaS companies and enterprise SaaS companies, all they do is maximization. Yeah.
How do you think about full stack versus SaaS? So like Flexport could have said we're building software and selling it in freight forwarders, but they're doing both. Or Atrium on the legal side. Yeah. How do you think about those two different businesses?
Yeah. So there's, let's talk about Bridgewater. Bridgewater is the largest hedge fund in the world. Bridgewater, most people don't know this, started as a software company selling software to hedge funds. Okay. Then what they decided, no one was going to buy that software because no one actually believed in the innovation. So they said, well, screw you guys, we're going to start a hedge fund. And what we're starting to see in a bunch of different categories, we just invested in a machine translation company. What ends up happening is this company called Lilt, PhD out of Stanford, professor from Cal, built the world's best adaptive neural machine translation system. They tried to sell it to all the different people in the translation ecosystem. No one believed. No one bought it. Everyone had this kind of innovator's dilemma where they don't actually want to change their business model. So what do? They create a competitor and start to build it. And so I think in categories where software hasn't been disruptive, there's no existing budget, the ecosystem is relatively staid and reticent to change, then I think building a full stack makes an enormous amount of sense. But I think you have to kind of convince yourself that the competition is so far behind you that you can just really waste the ecosystem.
As a follow-up, how do you think about the growth and margins?
Yeah. So those businesses tend to have lower margins, right? So they'll have kind of 50 to 60% gross margins, which is closer to Twilio, whereas a classic software business, public traded median 72%. Most, some of them are kind of in the 80% range.
Atlassian.
Yeah, Atlassian is probably much higher because most of the software is actually deployed on-prem, and so you're kind of like 90 or something like that. So I think the trade-off that you make when you do full stack is the total addressable market is actually larger because you're capturing a much larger fraction of the budget as opposed to just the software spend. You're capturing the entire spend. So in Lilt's case, like a company like, what's a good example? Microsoft spends $750 million on translation a year. Okay? If you sell software, maybe you can get 5 or 10 million of that. If you sell the whole stack, you can get a tenth of it, you can get 75 million. It's going to be at a lower gross margin, 50%, but your TAM's much larger. So that's the trade-off.
Yeah. And anything about tracking growth rates, like compared to a SaaS business that's maybe slower to scale than software?
I think the full stack is actually faster to scale. I think it's faster to scale because if you're building a full stack, the buyer is going to be far more receptive to an offering that looks like the incumbent as opposed to a software offering. Like I said, the budgets are bigger, and so your sales cycles should have far less friction and you should be able to grow faster. If you really wanted to equate business per business and look at growth rates, you'd look at gross profit, right? So you basically just multiply the revenue times the gross margin to get the gross profit. But I think, what we're starting to see, another big trend in SaaS is we're starting to see really tech-heavy companies. So if you look at like Lilt that's doing machine translation, of course, that's doing speech rec, they're using a lot of GPUs in order to provide their offering, and that's actually the cost of goods sold, the amount they spend on infrastructure is material and actually depresses their gross margin relative to other like SaaS 1 or SaaS 2. And so we're starting to see kind of a lower gross margin profile. And that will change as GPUs become less expensive and their ASICs kind of built for that. But I think it's something that's, I think as long as the top line growth looks really good, the gross margin is not an issue. If you're in a 30% growth range, that's an issue. But if you're kind of 50, 60.
I'm gonna jump in with another interesting, spicy question. GitHub for $7 billion. What the fuck?
Oh, it's such a good buy.
Please explain.
It's such a good buy.
So GitHub recently got sold $7 billion. Revenues are 300.
Yeah, so they paid. So
Like 4% of it.
yeah, they paid the single largest multiple for any enterprise software sale above $1 billion by 2x. Okay, just to kind of give you a sense. And I think it will be one of the best purchases Microsoft will have ever made.
Okay.
And the reason is, one, it's a network effects business. Those are really rare. The second is Microsoft really cares about identity. That's the reason they bought Skype. That's the reason they have an Active Directory. They don't have identity within the developer world. Okay, they want that.
So their take is that the GitHub identity is going to be the de facto.
Yeah, I mean, if you're an engineer, it's your resume.
Sure. Yeah.
Right?
Agreed.
The third thing is they're second place in the cloud wars, and they need to be first.
They're willing to play a premium.
Yeah, and so now you have the on-ramp of every developer into coding and infrastructure. So if I'm a new developer, I'm just graduating from college, I'm going to start a new project, where am I going to start it? I'm going to start on GitHub, right? The second I want to push it into production, if I have a one-click button to push it into Azure and deploy either serverless or whatever, I can do it. Boom. It's fully integrated.
Well, they're actually going to use the SPC company called Render, which is building that. But yeah, maybe we'll deploy to Azure in the future.
Yeah, well, I think serverless is a really big wave that we're starting to see.
Yeah,
and you can imagine what I want to do is, I want to instantly clone an application or a function and then deploy it to Azure instantly. Instead of downloading the library and packaging it up into a container, pushing it, you just kind of get rid of all of that. And then the third thing is, it's an enormous asset in acquisitions.
Oh, just because you have yeah, that's a fair.
You've got all the data about which open software is being used, who are the engineers building it, right? It's like a LinkedIn, like they bought LinkedIn for CRM. They're going to do exactly the same thing for the
It's
developers.
also just like a great way to hire the best engineers.
It's a huge strategic data asset.
I thought they should have paid 10. Okay.
Did you have a follow-up question?
No, that was helpful.
All right, more questions, folks? Come on. No?
So Twilio has it has a service play, but there's also like suppose there was another competitor to Twilio that said that okay, Twilio is overcharging, I'm going to offer this at half the price.
Yeah.
Do you think that is a good play, or what do you think about that?
No. So competing against Twilio, offering half the price. I think if your only differentiator is price and you have a smaller balance sheet, you will lose. So there's this Harvard Business Review case. It's the American Airlines case. And American Airlines, this is the 1950s. American Airlines is kind of at the peak of its game. And there's a new entrant that comes in. And they come in and they underprice American Airlines. Okay. What American Airlines does is it decreases its prices to be 10% below the new competitor. And they put the new competitor out of business. And then they go back and they increase their prices again. It's actually against the law now. It's called predatory pricing. But it still happens in business. And so if you're Twilio and you've got $500 million on the balance sheet and you see an up-and-coming competitor that is charging half of what you're charging in certain geographies or areas, what are you going to do? You're just going to lower your price to be below variable cost and push them out of business. In other words, there's no sustainable competitive advantage unless you can raise way more money and just wait them out.
It's a shit business to be in.
Yeah, it's a race to the bottom.
Yeah, it's a race to the bottom.
I know you're an avid reader, so I would ask a question. What do you think are the top 3 books everybody should read?
Why We Sleep. You guys heard of this book? All this research about? You are? It's ridiculous, right? Like your mom tells you should sleep. This is all the reasons why you should sleep. I used to prioritize working out above sleep. It totally changed. It's like if you sleep 6 hours, the risk of an accident in a car goes up by like 50%. If you sleep 4 hours, it goes up 11x. Right? And so the question I was asking myself is like,
so what's the break-even point? What is the 7 hours?
Yeah, you really want to sleep about 7 hours. And so, like if I was asking myself, like, would I make $1 million decision on 3 glasses of wine. Right? If I were CEO of a company and I had a chance to invest $1 million into a particular project, would I drink 3 glasses of wine and then make that decision? The answer
Bobber speak is 2.
right? And the answer is definitely not. And so the corollary to that is, would I make $1 million decision on 5 hours of sleep? Or a $10 million investment decision on 5 hours of sleep? The answer is no. I wouldn't. Okay. That one's really good. There's one called the management myth. So there was this guy named Taylor who kind of invented the whole notion of quantifying business. And it turns out he was a complete liar and fabricator. And this book basically debunks almost all of management consulting.
You didn't have a book to tell you that.
It's a really interesting read. That one was really good.
Yeah.
And then, what's the third one?
So I'm taking on the title there.
Yeah, the third one, I really loved Shoe Dog.
Oh my gosh, such a good
It
book.
was a ridiculously good book. Yeah, I really love that book. Just a great story.
He basically went all in with everything he had for 17 years straight.
Yeah.
And that's just like mind-boggling. Like,
Yeah.
like everything he had, double mortgage, everything.
Yeah.
It's like go all in every year for 17 years. And just
It's just like Musk. Just like
except
Elon.
he made a profit.
That's true. That's a big difference.
Yeah, it is just like Musk.
Yeah.
It's insane.
Yeah, there are very few people. So a buddy of mine, he works at a quant fund, and he was fired from the quant fund because one day he made a trade that lost him $50 million. Lost the firm $50 million. And I called him afterwards just to kind of console him. He's like, I don't need any consolation. And I was like, well, what do you mean? He said, I asked him, like, are you going to have a hard time finding a job? I mean, you just lost $50 million. And he said, no, I've got all these job offers. And I couldn't believe it. And he said, there are very few people who are willing to make those trades at those stakes.
So basically, he's proven his mettle for like having a higher risk tolerance, and that's what you want with yeah. So the loss is proof that
he's willing to stake it, right? And would you be willing to stake everything on one bet and then make a bunch of money and take everything again?
So it sounds like the right analogy in the startup world is start a first company, raise a fuckload of money, lose it all, and then just be like, this is how crazy I am. Give me my second round. Okay. You know, the thing is, it would probably work. Okay. Did you have another question? Yeah.
If you think about I still find your whole sort of approach to growing a company, especially in the beginning, kind of interesting. If you had to think about most of us who are doing SaaS kind of stuff, the standard approach is essentially you go about, you find a couple pilot customers, you get them to onboard for free or for some small amount. Is there any deviation from that pattern that you would do for the beginning of a company in terms of best chances of growing, getting success? And would you do it for network business? Would you do it differently for network businesses versus non-network effect businesses?
Okay. So I think that model works really well for most businesses, and the reason is you need proof points at the beginning. Well, okay, so from a founder's point of view, you want to make sure that the product that you're building is exactly the right one, and so you want to develop for a handful of different customers. And so most of the companies we work with, they start with about 20 to 25 potentials, and then their goal is out of that 20 or 25 to convert somewhere between 3 to 6 to paying customers in 6 to 12 months. And the reason they do that is, 1, they want to prove the willingness to pay, 2, they want reference customers in order to raise a round, and 3, actually maybe it's just 3, so let's just stick with those. In a network effects business, I still think you want to focus on, what you really want to do is you want to find a small subset of people who are really rabidly enthusiastic about your product. If you think about all the great consumer products, that's how they started, right? And the word of mouth is really critically important. And so a change in your strategy, the alternate strategy would be to try and get as many different people as early on as possible in a network effects-based business with the hypothesis that building the network effect really quickly would benefit you. But I think in software, you still want to remain focused on a small set of people so that the core of the network is really powerful. I remember when Ben started Pinterest, he grew the user base to 100 and then to 1,000. Okay? And then he stopped it at 1,000. And he went through and he watched everybody's behavior. And he threw out about 250 or 300 people. Because he didn't want those people to influence the culture and the development of the network. He wanted only people who were kind of participating in the network that really embodied those values. And so I think that's a really long-winded way of saying I think that strategy probably works in both cases.
Each of those single first 1,000 people, Ben personally called or emailed to basically convince them to join his network. I mean, like, he hustled so hard to get those 100 people. And I mean, even if you're building a social, local consumer product, the amount of kind of energy that he put into finding those first 1,000 was remarkable, actually. And I think it actually played a big part in, like, kind of like the ethos the whole community developed.
Exactly right. And then he published principles. And so that was really critical. So I think in network effects businesses, creating the values and the cultures and the mores in that network is, like, this is the downfall of Data.com, right? Because what ended up happening, so Data.com was a company that Salesforce bought for about $75 million. The value proposition was, it was sold to an account executive. The idea was only 20% of the people that you talk to in your history as an account executive can convert to paid if you're at a typical SaaS company. And so 80% of those leads are kind of going to waste. So put them in a database so that other people can use them. And it's give to get. So if I put in 5 business cards, I can get 5 business cards back out. Okay, great, like awesome. Like network effects based business, super high willingness to pay, like totally linked to revenue, really, really interesting. The problem is they didn't set the culture the right way. So what people would do is they would put in their worst leads. Right? And so it was just a bunch of garbage.
Sounds like LinkedIn data, but okay.
So that's why it's so critical, right?
Okay, I only have one more question, so if people have more, go for it.
Oh yeah, so I was wondering about whether the type of sales, the company's sales strategy, can affect the product at short version. So you talked about bottom-up sales earlier, and a lot of times in that case, the individual user making the decision whether to use a software product or not, which is different than a purchasing department making it.
Yeah.
Seems like the way to sell to a purchasing department is to make really high-blown claims, and then maybe the follow-through isn't all there, but the way to get people to talk with their colleagues is to have a really great product. Does that sort of happen on a large scale, or is it not something you've seen?
Yeah, another common mistake with startups is they don't align their go-to-market strategy with their pricing strategy. So Intercom made this mistake really early on. They hired inside sales reps. Inside sales rep costs like $120K in San Francisco, and their ACVs, their average contract value was about $2,400 a year, right? And so what you do is like give this person a reasonable quota. Like let's depress the quota. Let's say it's $400,000 a year. You kind of back into this person has to sell like 100 or 200 customers a year, right? If they're working 200 working days, which would be crazy, then they're selling a customer a day. Completely unrealistic. So that they're making 5 qualified calls. I mean, you just kind of do the math. And so I think you really have to kind of think about like what they ended up evolving to is that only customers that were worth more than, I think it was $8,000 per year, eventually got to talk to a human, and everybody else was self-serve.
It's also a problem that Dropbox really struggled with, which is like if you hire an enterprise sales rep, which is what? $250. At Dropbox's price point of like $10 per user per month, and often discounted for an enterprise like company because they have some leverage. It's almost impossible for them to hit their quota.
Yeah.
Like if you have some multiple on 250, but then everybody tells you that no, you should have an enterprise sales team because there's a bunch of them up, and then you realize over time that like unless your pricing is aligned with your go-to-market, those things that if you don't get those aligned, your economics are going to completely destroy you.
Yeah.
So instead of asking my last question, which I realize is just not that interesting, why don't we take 4 or 5 minutes and we'll answer questions for you. And if nobody else here answers, then I'll answer it. I'll try.
No, this is really interesting. How do you guys think about competing against incumbents? So one of the hypotheses that we have is that the major categories, like the major systems of record, like you think Salesforce for sales, Zendesk for customer support, all those companies are now large enough that you can take a customer segment out of their population and actually build a public company on that. How do you guys think about, is that a theory that you guys, or a hypothesis that you guys are thinking about? Is that, when you look at an incumbent, maybe I'll ask it a different way. If you're competing with an incumbent, upon what axis are you competing? Are you competing directly against them? Are you competing against a product or price or distribution?
I think obviously there's a lot of ways to think about it. One, my background is hardware, so I think about Innovator's Dilemma a lot, and in that book specifically, there was a classic attack from the bottom where the big companies were all thinking about sort of like larger and larger contracts, more and more features, and you could have a really limited feature thing that built into one thing, but it was cheaper than what the main offering was, and attack that way, right?
Yeah.
Fashion, sort of the opposite. There's a classic attack from the top, where the main brands are like reducing their costs, but their brand kind of gets crappier as they reduce their costs. You can come in with something that's like, somehow you market and PR like it's really great, and you actually have the quality really high, and sort of come in there, and there's a like general move down. I think you see both of those in software also. Yeah. And then another common thing, especially in hardware, is that you can think about like starting in some niche and then like growing from a niche. Like you need your first 100 customers or so to be really committed and really love it, and you can find those first 100 like in a certain area, and then you have to sort of just manage your crossing the chasm problems that you get to a larger audience from that small initial product.
Yeah. Here's another question. What is the most...
Can I also take a crack at adding that?
Yeah.
One thing I'd add is like I think one of the other interesting side effects of what you said earlier about every function having budget, and also buying decisions being increasingly decentralized, is that it's actually interesting that if you build something, and also like I think a lot of knowledge workers or highly paid workers are increasingly more, they have this desire to like be more productive.
Yeah.
They're like, I want to have 7 hours or 8 hours a day to do work, and I want to use the best tool for the job.
Yeah.
So I actually think the switching cost is decreasing in my opinion.
Yeah.
So you can actually tip over like a small team, and also you don't need to tip over the whole company.
Yeah.
You can be like, there are only 3 or 4 people at this company, and if they love my thing, cool. They're just going to expense it, pay for it personally, expense it. It's not that expensive. And I think that's really fascinating, because what that means is that if you can have a strategy that focuses on, ideally not just individuals, but small teams, and then you figure out some kind of tipping for those teams in those companies, and critically, and I think not too many people have figured this out, I think Slack has, if you can get teams to have virality with other teams, then you win.
Yeah.
And I think that snowball effect can actually happen way faster than most people think.
Yeah.
But I haven't seen too many companies figure out that last part, which is like, how do you get like, if you have 10 small teams of 5 each in a company, how do you get them to start interacting with each other? I mean, this is what Dropbox is also trying to figure out right now. I don't think they've quite cracked it. But that's one way.
Yeah.
And it's also cheap.
Yeah. What's the most inspirational SaaS company today?
I'm biased, but I'll let somebody else answer. Inspirational.
Yeah, like the most innovative.
Well, those are different things. Inspirational company need not be innovative.
Yeah. I don't have a point of view.
No one?
I think Figma is pretty interesting.
Yeah.
Rebuilding Photoshop in the browser without need to install any piece of software. It's basically like collaborative from the start and so on. I think there is a sort of a growing community around it that I find pretty interesting. I think also it's aligned with designers getting an increased leverage inside of organizations, and it sort of makes it possible for non-designers inside of organizations to do design work, which I think is a need that is required by more and more firms as design is becoming more and more important, but there's a shortage of designers throughout the world.
My answer would be Salesforce.
Yeah.
Surprisingly enough, it's because they've always built crappy software.
Agree.
That is hard to use.
Yeah.
Like it'd be hard to imagine like a CRM software that it's easy. But the combination of their chutzpah and their like acquisition strategy and their like capability of integrating some of these companies, selling bundled things that they've acquired, is insane.
Yeah.
Their pricing is incredible. Their ability to like sell the dream not just the reality, is also incredible.
Yeah.
And I don't know. I wish that a lot of the other founders, generally in SaaS, that I deeply respect, would kind of take a little bit from Benioff and understand that like you're not just selling. It's not just about the software. It's not just about the product. It's not just about the design. It is really about the overall experience, and also just like a deep understanding of who is the user, who's the buyer, and just I don't know. I think they get a lot of that right.
Yeah, they do. George Hu was the COO there for a long time. He said something really interesting to me, which I think is broadly true but not universally true, which is most SaaS software, you're selling a report. So Salesforce, the reason that they charge so much and they're able to get so much is the pipeline report. And that's what got the business. They had 50 account executives 18 months after launch.
To like 10,000. So, yeah.
Last question is, how can VCs like us be more helpful to you?
If I'm hiring for sales or for kind of biz ops or somewhere in there, what kind of people am I looking for? Like, what are the heroes? I know how to hire engineers. I'm an engineer.
Yeah.
I know how to hire designers. I work with designers. But
Yeah.
when it comes to salespeople,
Yeah.
it's somebody who
Great
is
question.
almost opaque to me.
Totally, great question. Okay, I'm going to simplify the universe for a second.
Cool.
There are two kinds of salespeople.
Yeah.
Okay. There are salespeople who solve puzzles, and there are salespeople who run plays. Okay. So there are some salespeople who are the whole goal is to kind of figure out how do I sell something, right? Like this product's never been sold, it's new, the buyer's new, the motion is new, and there are people who love and thrive on just solving that puzzle. And you want to, at the beginning, what you're looking for is 2 or 3 people who look like that. Okay? And then you're going to outgrow those people in about 18 months, and they will go someplace else. And then after that, you're going to hire a sales leader who can take that playbook and build out the team. And they're just going to run that playbook and optimize that playbook.
The transition happens pretty quickly.
What's the one question you'd ask to determine a puzzle solver versus an executor?
I would give them a case. I would like sell this pen to me, right? And then something like that.
Would you use your business?
I would use my business.
The other thing I would do is just like ask them to recount the longest sales cycle that they ever had, and basically give you like 5 touch points that they had, and other touch points basically like, you know, met the corresponding person, took them out for dinner, versus like actually I noticed something that I thought might be useful to them,